Most people think the copper story is written in the obvious places. Chile, Peru, the Congo, China's smelters, Washington's trade policy. The kind of headlines that hit every terminal and every feed at once. But sometimes, the market's next big clue shows up in a place that feels almost too quiet. Because earlier today, a small, highly specific number hit the wire, and if you understand what it actually means, it forces a totally different question. Not is copper going up or down next week? The real question is, what happens when the world is desperate for copper, but the only new copper that really changes the math is high-grade copper? And high-grade is getting harder to find. Here's the number. A 5-meter interval at a project in Quebec just reported 12.83% copper equivalent, driven by 6.15% copper and 7.93 grams per ton of gold, sitting inside a broader 19-meter interval grading 3.59% copper equivalent, starting at 913 meters depth. If those numbers sounded like a foreign language, perfect. Stay with me, because what I'm about to do is what almost nobody does in real-time finance content. We're going to translate the headline, then stress test it. And by the end of this video, you'll understand why a single drill interval can be a trap, why it can also be a signal, and how this kind of tiny data point can ripple into the bigger copper narrative that everyone is watching. Because in commodities, the future isn't always announced with fireworks. Sometimes, it's announced with 5 meters of rock. Let's start with the most important mental reset. A drill result is not a mine. A drill result is a measurement, a small window into a much larger system. It's like shining a flashlight through a keyhole and trying to map an entire building. So if you're expecting me to say, this guarantees anything, I'm not going to. That's not how geology works, and it's not how investing works. In mining, grade is oxygen. Not in a motivational way, in a math way. Grade is what lets a deposit survive the real world. Higher costs, higher interest rates, supply chain delays, and the fact that every mining project on Earth looks incredible on a slide deck, and then becomes a fight with gravity, chemistry, and budgets the moment it touches reality. So when you see a number like 6.15% copper, your brain should immediately ask a practical question. How much copper is that, actually? A ton of rock is 1,000 kilograms. 1% copper means 10 kilograms of copper in every ton of rock, before recovery losses. So 6.15% copper is about 61.5 kilograms of copper in every ton of rock before processing and metallurgical realities take their cut. That is not nice. That is not decent. That is violent in a purely mathematical sense. And then you add 7.93 grams per ton of gold, which matters because gold is not just another metal. Gold is value density. Gold is what can turn the same rock into a very different project economics conversation because it can carry costs in a way that base metals alone often can't. Now, the company didn't stop there. They went one step further. They said that using current spot pricing, that 5-meter interval equates to 18.15% copper equivalent. That line is powerful, but it comes with a subtle warning label that you need to understand. Copper equivalent is not a law of nature. Copper equivalent is a conversion. It's a way to say, this rock contains multiple metals. If we convert the value of those metals into the value of copper, what would the equivalent copper grade be? It depends on metal prices. It depends on recoveries. It depends on smelter terms. It depends on payables. It depends on whether the gold is actually recoverable in the way the model assumes, not just present in the rock. So treat copper equivalent as a translation tool, not as a guarantee. Still, even with that caution, the core point remains. This is a high-grade intercept. And the market loves high grade for one reason: optionality. High grade gives you more ways to build a mine plan that works, more flexibility in sequencing, more resilience in downturns, more margin potential when things go right. Now here's the part almost everyone misses. A single intercept can be exciting, but the real story is whether the high grade is isolated or whether it connects. Because mining is not about finding a lottery ticket. Mining is about building a continuous system you can actually extract. So what did this press release say about continuity? It said this new intercept is approximately 125 meters east and up dip of a previous hole that returns 17.91% copper equivalent over 6.3 meters. And the company framed this as continuity across a high-grade corridor. This is where mining stories either mature or die, because a high-grade hit by itself can be a spike, a one-off. But a high-grade hit that lines up with another high-grade hit in a coherent corridor begins to look like a zone you can model, and eventually, maybe, a zone you can plan around. The company also said additional drilling to the west and at depth continues to expand the mineralized system, and that 2 holes intersected the copper-gold horizon, extending resource-grade mineralization by an additional 250 meters down plunge. Now pause and notice what just happened. We started with 5 meters, and within seconds, we're talking about corridor continuity and a system extending down plunge. This is how real supply gets built, not with one monster number, with repetition, with geometry, with a growing envelope that stays mineralized as you step out and step down. That's why you'll hear serious mining investors say something that sounds boring, but is everything. Show me the next hole. Now let's zoom out to the bigger framework of what we're looking at. This company is Abitibi Metals, and the project is called B26, described as a polymetallic deposit in Quebec's Abitibi mining district, with a focus in this release on copper and gold, and with a broader resource that includes other metals as well. A polymetallic deposit matters for the same reason copper equivalent exists. Multiple metals can diversify revenue streams and change the threshold for viability. But they can also complicate metallurgy, concentrate quality, and the commercial terms you get from smelters and buyers. So this is not automatically better. It's different. And you should treat different as a double-edged word in mining. Now, here's another detail that matters more than people think. Depth. This intercept starts at 913 meters depth. Depth is not just a technical detail. It's a cost structure clue. At shallow depths, you might have open pit optionality. At deeper depths, you are generally talking about underground development, which can be capital-intensive, time-consuming, and operationally complex. On the other hand, underground mining is also where the industry often finds its most beautiful grades, because high-grade systems can continue down and tighten into richer zones. So depth can be a challenge, but it can also be where the real prize lives. The question is not deep is bad or deep is good. The question is, does the grade and continuity justify what the mine would have to become? Now, let's talk about what phase of the story this is, because that defines the risk. The company says its Phase 3 drill program was completed in December 2025, totaling 24,544 meters across 40 drill holes, with assays from 3 remaining holes still pending. That is not a casual amount of work. That is the kind of drilling that is meant to do something very specific. Take a deposit from interesting to definable. They also said results to date define a continuous high-grade zone approximately 250 meters vertically and 500 meters laterally, and that it remains open to the west and at depth. Open is a seductive word in mining. Open means the deposit is not closed off by drilling. Open means potential, but open also means uncertainty, because until you drill it, you don't own that volume. It's an invitation, not a promise. Now let's address the part that finance creators often skip because it's not dramatic, but it's the part that actually determines who gets paid if a project succeeds. Ownership. Abitibi Metals said it currently holds a 50% interest in the B26 project, and has the option to earn an additional 30% interest from Soquem, which is a subsidiary of Investissement Quebec. If you are new to mining, this is crucial. A company can discover something incredible and still not capture the full upside if the ownership structure is complex. An earn-in can be great because it lets a smaller company access a project without buying it outright. But it also means you need to track the terms like a hawk. What must the company spend? Over what time? What milestones unlock the additional interest? What happens if they miss a deadline? How are budgets approved? Who controls operations? Mining stories can go sideways, not because the rock failed, but because the structure quietly diluted the upside or created decision friction. Now, we need to talk about the resource base, because drill results are exciting, but resources are what turn excitement into an actual market framework. The company stated the current B26 resource stands at 11.3 million tons, indicated at 2.13% copper equivalent, and 7.2 million tons inferred at 2.21% copper equivalent. Let me translate that, because those two words, indicated and inferred, can change how you should think. Indicated is higher confidence. It's still not certainty, but it's more defined. Inferred is lower confidence. It's closer to an informed estimate. Markets love to pretend all tons are equal. They are not. And at some point, if a deposit is going to become a mine, the risk has to migrate from inferred to indicated, and eventually into more tightly defined categories, supported by tighter drill spacing, better geology, better geotechnical understanding, and eventually more engineering. So whenever you see an exciting high-grade intercept, ask yourself one question. Does this help upgrade the resource, expand the resource, or both? Because expanding without upgrading can still leave you with uncertainty. Upgrading without expanding can still leave you with a ceiling. The best stories do both. Now, another detail in this release matters for a reason that has nothing to do with geology and everything to do with timeline. The company noted the deposit is located just 7 kilometers southeast of the former Selbay mine and highlighted established regional infrastructure. Infrastructure is not a footnote in mining. It is gravity in mining. Roads, power, a skilled workforce, a mining jurisdiction that knows what mining is, all of that matters. Because when you don't have infrastructure, your capex can explode, your schedule can slip, and your project can die slowly while the market moves on. So with that groundwork, here's the big moment. Why should anyone who cares about copper globally pay attention to a drill interval in Quebec? Because the copper market has entered a new phase. And in this phase, the market is not just asking, do we have enough copper? The market is asking, do we have enough economically viable copper at the right grade, in the right places, at the right time, with the right permitting and the right capital, in a world where the cost of everything keeps rising? That is a very different question, and it's why high grade matters more than ever. A lower grade deposit can still become a mine, but it needs more things to go right. It needs cheap energy, it needs stable costs, it needs smooth permitting. It needs the commodity price to cooperate. It needs the capital markets to stay open. High grade gives you a buffer against reality. Now, let's talk about the psychological side of this, because psychology moves capital long before a feasibility study does. The copper narrative in 2026 is dominated by two forces pulling in opposite directions. On one side, you have the demand story: electrification, grid upgrades, data centers, defense manufacturing. The simple fact that copper is the metal of moving electrons, and modern economies are in the business of moving electrons. On the other side, you have the supply story: declining grades at mature mines, longer lead times, political risk, water constraints, community negotiations, permitting complexity, and capital discipline, which is a polite way of saying miners have been burned before and they don't want to build expensive projects that don't pay out. So the copper market is trapped between need and friction. Now think about what a high-grade intercept does inside that trap. It doesn't solve the global deficit, but it changes something else. It changes credibility. It's a reminder that new, high-quality supply still exists, and when it appears, it attracts capital quickly, because capital is hunting for the few projects that can actually survive the next decade. That's the macro reason these tiny micro headlines matter. Now, I want to slow down and do something that will protect you as a viewer. Because if you're watching finance content, someone out there is always trying to use your attention as a lever. Here is the honest risk framework. First, the rock can lie. Not in a literal sense, but in the sense that early results can create an impression that later drilling doesn't confirm. Second, metallurgy can disappoint. A deposit can look incredible on grade and still have processing issues, recovery issues, concentrate penalty issues, or complexity that eats the economics. Third, mining costs can inflate. A project can be high grade and still be crushed by cost overruns, contractor shortages, energy prices, or simply poor execution. Fourth, ownership structures matter. If you don't track who owns what, you can end up cheering for value creation that doesn't accrue the way you think. Fifth, markets can change the rules. Copper prices can move, gold prices can move, credit conditions can tighten, equity financing can become expensive. The whole risk appetite cycle can flip. So if you take one thing from this part of the video, let it be this. A drill result is a data point. Your job is to see how that data point fits into a system. Not just the geology system, the financing system, the permitting system, the operation system, the macro system. Now let's bring it back to what happened in this release, because the details hint at what the company is trying to build next. They framed this as momentum in what they call the Western Downplunge high-grade zone. That phrasing is not accidental. Downplunge implies the mineralization continues along a direction that can be followed and tested. Western implies there is a lateral vector for expansion. High-grade zone implies they believe there is a core that can anchor the economics. What mining teams try to do with a high-grade zone is fairly predictable. They try to define it. They try to tighten drill spacing. They try to show continuity. They try to build a case that this zone could be a higher margin component of a future mine plan. Because if you can build a mine plan around a higher grade core, you can often improve payback, reduce risk, and attract better financing terms. Now remember, this is not guaranteed, but it is the strategic blueprint. And it's why those step-out details matter. Because if the zone stays high grade as it expands, the story becomes stronger. If it fades or becomes erratic, the story becomes more speculative. Now here's another subtle point that ties this directly back to how markets actually trade. In copper, everyone watches the price, but price is only part of the equation. The other part is margin, and margin is often decided by grade. When copper prices are high, marginal projects look viable. When copper prices are volatile, high-grade projects look safe. So high grade is not just a geology flex, it's an investor preference. And in periods when the market is nervous, preference becomes capital flow. Now you might be thinking, okay, but how does this matter if it's not producing copper today? This is the difference between traders and allocators. Traders trade what is. Allocators position for what could become. And in commodities, the gap between discovery and production can be many years. That is why early signals matter. Because by the time a mine is producing, the market has already priced the story, financed the build, and moved on to the next thing. So if you're watching copper as a multi-year thesis, you don't just watch the big producers. You watch the pipeline. You watch the projects trying to become the next producers. And you watch the projects that might never become anything, but still reshape sentiment as they reveal new high-grade systems. Now, I want to give you a clean way to think about what to do with information like this, without turning it into personal investment advice. Here's one approach that sophisticated investors use. They separate the world into copper exposure buckets. One bucket is established producers, lower geological risk, higher operational exposure, and you're trading cost control, political risk, and capital returns. Another bucket is developers, higher risk than producers, but with a clearer path to a mine, and typically more sensitivity to the commodity price and to financing conditions. Another bucket is explorers, maximum uncertainty, maximum optionality, and stories are driven by drill results, resource updates, and the market's appetite for risk. This Abitibi headline sits in the explorer to developer spectrum. And that's why the market reaction, if there is one, tends to be fast, emotional, and narrative-driven. Now, the reason I'm saying this is because it lets you ask the right question about your own strategy. Are you trying to trade a drill result? Are you trying to build a copper thesis? Are you trying to hedge inflation risk? Are you trying to diversify equity exposure? Because the same headline can mean different things depending on what game you're playing. And if you don't know what game you're playing, the market will choose one for you. Now, let's go back to the numbers one more time, because this is where the story becomes almost cinematic. A 5-meter window produced a copper equivalent grade that is so high it forces a reaction. But the company didn't present it as a random spike. They presented it as part of a corridor, with a nearby previous hole that was also extremely high grade, and with further drilling that extends the system down plunge. That combination is exactly what serious mining investors look for. Not just one great hit, a pattern. Now, to keep this advertiser friendly and responsible, I'm going to say something very clearly. This is not a recommendation to buy or sell anything. This is education and analysis, because what matters is the framework. If you can build the framework, you can evaluate any headline, not just this one. And with copper and metals headlines coming at you every day, that framework is the real edge. Now, here's the final twist that turns this from a company-specific story into a market-wide story. This press release also pointed readers to the company's X account and its broader social channels, which tells you something about the environment we're in. Mining used to be a slow information game. Now, it's an attention game too. And when attention meets a commodity with structural demand and tight supply and political friction, you get volatility. You get narratives that move money before facts have fully settled. So your edge is not in reacting faster. It's in reacting smarter. It's in reading the headline, then immediately asking, what is the grade? What is the width? What is the depth? What is the continuity story? What is the ownership structure? What is the resource base? What are the next catalysts? What are the failure points? And when you do that, you stop being a passenger in the metals story. You start being an analyst. So here's what I'll be watching next. I will be watching whether the remaining Phase 3 assays reinforce the same corridor story or introduce variability. I will be watching how the company frames Phase 4, because the way a team designs its next drilling tells you what they believe the system actually is. I will be watching whether the high-grade corridor expands in a way that is mineable, not just exciting. And I will be watching the macro tape, because copper doesn't exist in isolation. Copper lives inside rates, currencies, risk appetite, and the real-world constraint that every country wants electrification, and almost no country wants a new mine near them. That is the tension. That is why high grade matters. And that is why 5 meters of rock can be worth a full video. Because sometimes the market isn't moved by a speech. It's moved by a measurement. And today, that measurement was 12.83% copper equivalent over 5 meters. Not a promise, a signal. And in a world that needs copper, signals get expensive fast.